What if you could secure your future without working extra hours? Imagine your money growing while you sleep. Today we're diving into the world of investing, a powerful tool for financial growth that can transform your life. Stay with us, because the last point we'll discuss is a fundamental step that many beginners overlook, and it's crucial for your success. Welcome back to Financial Blueprints. If you're new here, we're all about helping you take control of your finances. And in this video, we'll introduce you to the basics of investing and explain why it's so important for your financial growth. Be sure to watch until the end for a key tip that can make all the difference in your investment journey. So why should you invest? Investing is a way to make your money work for you. Unlike a savings account where your money just sits, investments can grow over time, thanks to the power of compound interest. This means your money earns money, which then earns even more money. Investing is crucial for long-term financial growth. It helps you stay ahead of inflation, build wealth, and achieve financial goals like buying a home, funding education, or securing a comfortable retirement. Now, let's break down the basics of investing. Investing involves putting your money into assets like stocks, bonds, mutual funds, or real estate with the expectation that they will generate income or appreciate in value over time. There are various types of investments, each with its own risk and return potential. It's important to understand these options and choose investments that align with your financial goals and risk tolerance. Stocks represent ownership in a company. When you buy a stock, you become a shareholder and can earn money through dividends and capital appreciation. Stocks can be volatile, but they have the potential for high returns, making them a popular choice for many investors. Starting with stocks can be a great way to enter the world of investing. Look for companies with strong fundamentals and growth potential, and remember to diversify your portfolio to spread risk. Bonds are loans you give to corporations or governments in exchange for periodic interest payments and the return of the bond's face value when it matures. Bonds are generally considered safer than stocks but typically offer lower returns. Including bonds in your portfolio can provide stability and income, especially during market downturns when stocks may be more volatile. Mutual funds and ETFs pool money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. These funds offer instant diversification and professional management, making them a good choice for beginners. Mutual funds and ETFs can simplify investing, allowing you to gain exposure to a broad range of assets with a single investment. One of the most important principles of investing is diversification, spreading your investments across different asset classes to reduce risk. A well-diversified portfolio can help you weather market fluctuations and achieve more consistent returns. Diversification is key to building a resilient investment portfolio that can grow steadily over time. And here's our crucial insight: start early and invest consistently. Time is one of the most powerful tools in investing. The earlier you start, the more you can benefit from compound growth. Even small, regular contributions can grow significantly over the years. Setting up automatic investments can help you stay disciplined and ensure that you're consistently investing, regardless of market conditions. So there you have it, an introduction to investing for beginners. We covered the importance of investing, the basics of stocks, bonds, mutual funds, ETFs, and the critical principle of diversification. If you haven't seen our previous videos, be sure to check them out for more valuable tips on managing your finances. And stay tuned for our next video where we'll dive deeper into different types of investments. If you found this video helpful, please subscribe to Financial Blueprints, give this video a like, and share it with your friends. Until next time, take care and stay smart with your money.